Tool on PowerOptions called the Market Sentiment Tool. What we're doing here is we're looking at 12 different indicators, 12 different market indicators, and we have a history over the last 5 or 6 years of what the market has done when certain indicators were at a certain point. So we have a distribution of each of those 12 indicators, and based on that we sort of gauged, is it a down market, is it a sell warning, is it a buy warning, is it a neutral condition, neutral market condition. Right now we see we're in a light buy. This is actually a change. As of today, earlier today, looking at yesterday's closed numbers, we were at neutral. We had one bearish indicator, we had 10 neutral indicators and 1 bullish. Well, we've changed now where it looks like we have 3 bullish indicators and 9 neutral. And what that means is that based on our numbers over the past history, looking at what the market's done when these indicators have a certain value of +3 or -3, the bullish indicator is given a value of a +1, neutral 0, of course, and then bearish is -1. But when we're around 3, it's sort of an indicator of a light buy. Well, what are these indicators and what are these histories that I'm talking about? Well, let's take a look. So on the main home tab, when you first log on to your trial account, you can see that market sentiment tool listed right there on your home pod. If it's not available there, you can always add it. But we can click into the View Indicator Details. We can also access the main market sentiment tool under that Signature Tools tab. Let's go ahead and click on the View Indicator Details. Okay, and let's take a look. So here we are again. We're seeing that light buy indicator. 0 bearish right now indicators, 9 neutral, and 3 bullish. All right, so down below we see what the different indicators are. So we're using as a very, indicators for a very short-term cycle. We've got the put-call volume ratio, and right now you can see that it's in a neutral setting, but it's actually kind of close to bearish. The SPX number of days up. So just simple short-term measures, the SPX up or down, a broad market indicator, and it's neutral, but it's a little bit more closer to the bullish side, but still right about in the middle. Some of our other short-term indicators is the percentage gap that the SPX is above its 20-day moving average. That's right at neutral. The percentage of stocks, it's total number of stocks, but the percentage that are over the SMA 20, and we see we're getting closer to bullish. So more stocks now are starting to rise above their SMA 20, so we're getting closer to a bullish measure there. New 52-week highs and lows. All right, so the number of stocks, the percentage of stocks, as a comparison of 52-week highs compared to 52-week lows. You see we're almost to a bullish range there. And then, of course, the VIX. And this is a counter market indicator. That's why it's reversed. So when we have a VIX at a lower price, we're getting into that range where it's a bearish indicator. And, of course, if the VIX jumps up to that $27, $30 range, it's usually a bullish indicator. The market's going to correct, perhaps, that it's been high volatility, maybe been declining. All right, so the other one's the TRIN indicator, the exponential moving average 10-day of the TRIN indicator. That's in a bullish setting. The relative strength index, the RSI of the SPX, that's a bullish. And the number of days that the SPX has been over its SMA 20 is now in a bullish indicator as well. Okay, and then the others are all neutral. SPX over the number of days the SPX is over its 100-day moving average, the gap, percentage gap that the SPX is above its 100-day moving average, and the number of stocks, the percentage of stocks, I should say, over the SMA 100. All right, now I want to go ahead and I'm going to take the SPX number of days over the SMA 20, and that's shown up as a bullish indicator. Well, does that mean that the SPX is currently above its SMA 20? No, it's actually below. And what we're looking at here on the distribution is these are all occurrences over the last 5 years or so that the SPX has been at or right around its 20-day moving average. 5.7% of the time of the last 5 years, the SPX is 1 day over the SMA 20. And, we go here 5.8% of the time, it's 1 day below. Well, we're at a range here where we're at about -13. All right, so our current value is the SPX has been below its SMA 20 for the last 13 days. Now, as we can see, the distribution over time simply tells us that we now have a lower probability that the SPX is going to start to reach 15 days, 16 days, or 17 days. It's still possible, but there's a low percentage of occurrence where it continues beyond these marks. So this is why it's kind of just leaning now into the bullish indicator, because it's been below its SMA 20 for an extended number of days, and you start to get into that range of a lower probability it's going to continue to move below to 23 days, 24 days, and so forth. So using these distributions, we've sort of we've set fences so that we can see here, we decided that, it's sort of a bullish indicator over the last 5 years when the SPX drops 20 days below when the SPX drops 12 days below its 20-day moving average, we usually tend to see the market start to recover. It has more of a tendency to move back into only, ranges 11 days under or 7 days under or 5 days under. It's going to start to pull back over time. Okay? Now, it's not saying that, tomorrow's going to be an up day or Monday's going to be an up day. It's just saying that this kind of warning sign here, that when it's been this extended and it's been below its 20-day moving average for this many number of days, the likelihood that it's going to continue to be 14, 15, 16, 17 days is relatively low. And now our days above, we set at about 20. So right about here, it happens about 1.1% of the time. In this case, when the SPX is 20 days over its 20-day moving average, we start to get to a lower probability range that it's going to get to 30 days over, 50 days over, and so forth. So this is how we kind of set these fences, and this is what these indicators are showing. Now, for every indicator, this is just the distribution level for the SPX days over the SMA 20, but you can also see this versus the SPX. So when I click on this tab here, it's kind of a truncated view, of course, but you see here what we're looking at is the number of days that the SPX, in this case, is above. And we've dropped down here. This was the big change over the reaction, of course, to Syria and some of the Fed comments here. We see that we've dropped to 1 day below, and then we just kept moving below and below and below the 20-day moving average here. So it's been 13 days below. As you can see, it relatively correlates to that, and as we've been moving up above the 20-day moving average, 10 days, 12 days, we're looking at that against the SPX as the SPX continues to move up. Now you can see the 5 years I mentioned here. So we see that we have 2008, 2009 historical data, 2010, 2011, 2012. You can look individually by year, or you can, of course, even choose to see all. Now the all gets a little bit mushed together because there's a lot of data points there. What we're looking at here is the selection that we have down at the bottom. And what we can do down at the bottom, you see we sort of have this window here that's only showing us about a 2 or 3 month period. But I can extend that. I'm going to click on the black dot here, and we're just going to increase our window. All right, so I'm going to move the window a little bit, move the window a little bit more, and then just a little bit more here. So now we have all, essentially, of 2013, from January 2nd, 2013 to today, where we can see, here's the SPX 22 days above its SMA 20. It's correlating to a movement in the stock, and then we have a fall. We have a drastic fall here in the days it was over. So we see a little pullback, it starts to move back up, little pullback, it starts to move back up, and so forth. Okay, that's just this particular indicator. Those of you who use RSI, SPX is a broad market indicator. This one here, we can see that the RSI is down at the relative strength index for the SPX movement itself is at 29. And of course, the standard views is that when the SPX is any RSI really, when it's below 30 or maybe below 20, that's usually an indicator that it's going to turn around and go bullish. And when the RSI is above 70, or in some cases people might say above 80, then that's when the market is going to turn bearish. Now, see, the last time we hit a market high, you can kind of see these numbers. The last time we hit a market high, relatively recent market high on 5/21, the RSI was at 87%. Last time we hit a market low, relative market low, 11/15/2012, the RSI was at 28. But you can see the distribution here over the last 5 years to get a kind of gauge saying, yes, okay, we're right at about the RSI here, right about 28 or 29. So this might be an indicator, of course, that it's going to have a slower probability of reaching an RSI of 28, 27, 26, 21, and so forth. All right, so that's how these market sentiment tools are set up, and that's what we're kind of showing you here with the indicator. Now there's also a sentiment history. Let's just click on that. So the sentiment history, what this is showing us is sort of to the last cycle. The last time we had a bearish sell warning, or a sell warning, was around August 2nd, 3rd, and August 5th. Okay, you see we've been in these neutral area, but we were getting closer to bullish, a little pullback, and then we've been getting closer there, and then the indicator sort of jumped up. Right, so we're ending today on sort of a light buy, in that light buy range. You can see we're extremely bullish buy, very bullish, light buy, neutral, sell warning, bearish sell, and then a very bearish sell down there at the bottom as well. And so what this is showing you is just the last 10, 15 days or so when the last triggers were. So there was 8-1, 8-2, and 8-5 when we hit sell warnings, and then we went into a neutral phase. And then today we sort of popped up into a light buy. We've got 3 bullish indicators and 9 neutral. Okay, so that's just sort of the history. And then, of course, we can look at the details. And I'm going to go back to the 5th of August. I'm going to take a look at the details there. All right, so this was the view that we had on August 5th historically. Investors, Power Options investors, subscribers, I should say, who subscribe to the historical fields, they can go back through all time to see what the indicators were on a given day. For those of you that are just on the standard 20-minute delay or the real time, you can still go back historically to the last event, from neutral to sell or from a sell warning or a buy warning to neutral. You can go back to that time period or just scroll back about 8 days. Now, but this one here, the sell warning, we had 5 bearish indicators and 7 neutral indicators, and the actual warning came up, was it on August? The first one jumped up on August 1st, I think it was. Let me go back one more. So it was 4 and 8 there, and 4 and 8 on August 1st as well, so it was a sell warning. Now, why is that important? Well, I can tell you. Of course, it's not only an indicator of you may want to make some adjustments. Let's see here. Let me just do something real quick. I'm going to pull up. You may want to make some adjustments to your positions, add some protection in that case, or those of you who know me, you've heard me on other webinars before, you know that in general, about 50 to 60% of the time, my investment capital is in the protected radioactive trades, married put positions where we use the different income methods to lower our at risk and potentially bulletproof the position and earn extra income. Now, okay, let me go back here. The reason why this was important, there we go, is on August 1st, August 2nd, and August 5th, when we saw a sell warning, I'm holding a few married puts, and the market had moved up significantly. Oh, that's interesting. There we go. Let me slide over the chart here for SPX, and let's just go back 1 month. All right. So I want to go back to August 1st, August 2nd, and August 5th. You see that there? Let me highlight it for you. That's August 5th, August 2nd, and August 1st. Okay? What we're looking at here is looking at those 3 ranges, up until today. What was this a good time to do? Well, for me and my married put positions, about 3 of them, Hertz, Johnson & Johnson, and I believe the IMAX Corporation, this was a good time to use income method number 1 to sell a call against these positions. At this time, I believe Johnson & Johnson was up around $95 per share around August 1st and August 2nd. We saw the sell warning. So being able to sell the 95 call worked out really well because, well, the sell warning came in, the markets dropped, not only the SPX, but now Johnson & Johnson's down at about $88 per share. I was able to buy back that 95 call for about 90% of what I sold it for on August 1st or August 2nd. I think it was August 2nd, actually. So that was kind of interesting. Now, if I was in a covered call position here and I saw a sell warning, I may have considered adding a put option to create a standard collar to protect against some of the decline on the positions, or I may have considered rolling the short call down to another strike to kind of add some protection. If I was in a naked put, I may have rolled down my naked put another strike if I already had one open. If I was in a bull put credit spread, I may have considered trying to get out of the position or maybe managing it. Now, we're not trying to say that we can predict the future, but this example here, kind of supports the evidence that those distribution charts that we use and those fences we set for each of those indicators, last time we had a sell warning, that worked out very well for me. So I took the sell warning. Instead of saying get out of my positions, I said, well, let me sell some calls right now and see what happens. And it turned out that it worked out very well as far as this premium goes. So I was able to close most of them. I'm leaving one open, but I closed, of the 4 calls I sold, around August 1st, 2nd, and 5th, excuse me, folks, I was able to, buy them back. My apologies, buy them back and take in about 75 to 80% of the expected profit not having to wait to September expiration. So yeah, I sold the September's, I didn't sell the August in those cases. So that's what the warnings can kind of mean there. So does this mean Monday morning I might go in and buy 1 or 2 more positions? Well, I don't know. I'm going to take a look and see. But that's what we're using the market indicator for. It's not only useful for helping you time trades of when you might consider buying in if you're looking at new positions, maybe waiting for a stronger buy indicator to maybe look at some long calls perhaps. Sometimes you always have to be concerned about missing the run. But yeah, we're in a light buy indicator now, so it might be interesting tomorrow. Tuesday, I should say, as we're going to be closed on Monday. The markets are going to be closed on Monday. So we can maybe evaluate if it's still a strong enough market to open up some new positions. And we'll see where we go after that. We'll see if the trend continues. But in addition to opening new positions, as I mentioned, it's also helping me to time when I may consider doing an adjustment or an income method. Oh, Carl says, thanks for showing the indicator with the blueprint. Yeah, it's kind of easy to do. We've had this up now. We've been playing with it in-house for probably a month or two, a month and a half. I'm sorry. We were making some corrections. We were setting up the fences. We started off with only 4 sentiment indicators, and we added the other 8 as we went through to find more of them. But yeah, I mean, for me, for doing the adjustments in the income methods, that signal on August 2nd, 1st, 2nd, and 5th couldn't have been more helpful to me. It was the perfect time to sell calls, and it was right. It was right at the top of those stock prices at the current time, so it worked out really well for me to apply an income. I also could have done income method number 6s. That would have worked out okay, but income method number 1 in this case worked out really well, because when I do that income method number 1, when I sell a call against the married put position, actually I'm kind of creating a bearish position. When I sold 95 call on Johnson & Johnson, I'm essentially saying I don't want the stock to be trading above 95. I think it's kind of maybe run out of steam, and the stock hopefully will stay up at that price, but if it pulls back, I at least got the premium towards the market top and I'm able to generate some of that value. This also worked out for me recently with the past 4 or 5 days ago, I think it was, with the 6 days ago, I'm sorry, no, it was on the 21st, I'm sorry, 8 days ago, 9 days ago, we opened a new married put position, and as the stock moved up, we started to see less bearish indicators. It was a perfect time again to sell a call there. And it worked out really well. The stock had moved up to our put strike price. We sold a call, and then it pulled back from it, so it worked out really well. That was, we got into the position, Lionsgate. We got in on the 21st, sold the call, which reduced about 1/3 of the premium on the 26th, and then the stock pulled back, and I think at one point we sold the call for $1. I believe it was the 36th strike, and we could have bought it back for about 40 cents. I'm leaving it open to September because I think it's going to expire worthless, and we'll be able to be in the position of generated that 2.5–3% there to reduce the risk and reduce our cost basis on the position. But this can be useful in every strategy. I'm using that as an example because that's where I've spent 50 to 60% of my capital. But it can work for any strategies I mentioned. You're doing credit spreads, you're doing the debit spreads, you're doing condors, for example, things of that nature. The market sentiment indicator can be very useful for you. And you can play around with it. Check the distributions there. Put-call volume ratio. This one's pretty simple. You can see just the put volume divided by the call volume. So we're in a place now. It's getting closer to bearish, right? So it's going to be bearish when the put-call ratio is greater than 0.7, but it's kind of hovering near there. It's getting close to that. So we're at 0.71 right now. But that's a very short-term indicator. The ones we saw that are bullish, they're more towards the intermediate or just standard short-term indicators as opposed to a very short indicator. All right. Well, that's what we want to discuss with the market sentiment tool. Remember, you can view it directly on the home menu. You can select it as one of your pods. So when you first log on in the morning, you can see it right there. And then, of course, when you go into View Indicator Details, or you click the link under the Signature Tools menu for the market sentiment, you'll be able to see more of that detailed information. And if you have any questions at any time about that new tool, just call the office anytime or just send us an email. We'll be more than happy to help you with that.